In an unprecedented move, Japan has just shaken the very foundation of global finance. For the first time in decades, one of America's most trusted financial allies has struck a blow that no one saw coming, triggering a market crash that wiped out $1.7 trillion in just days. Japan, the once largest foreign holder of U.S. Treasury bonds, has begun aggressively reducing its holdings. An action so monumental that it could forever alter the financial landscape. With the global economy teetering on the edge of uncertainty, the question now looms. Is this the pivotal moment when the world stops trusting the US dollar? Let's make one thing abundantly clear. Japan is no rogue state. It is the world's fourth largest economy, a financial powerhouse with decades of history as one of Washington's most loyal partners. For years, Japan has dutifully purchased US debt, effectively becoming one of the pillars supporting the American financial system. But in January 2025, everything changed. Japan, in a stunning and decisive action, sold off a staggering $119.3 billion in U.S. Treasury bonds. This is the largest quarterly drop since 2012, according to Treasury International Capital, TIC, data. The sell-off is not just a random fluctuation. It signals a seismic shift in global finance, as Japan has now ceded its position as America's largest foreign creditor to China. The Bank of Japan cited domestic yield curve adjustments as the primary reason for the move. But this explanation rings hollow. Economists, including HSBC's Frederick Niemann, argue that this is far from a technical adjustment. It's a strategic decision. Japan, once a steadfast believer in the US financial system, has begun to hedge its bets. The action is a clear message that Japan no longer feels secure in America's fiscal stability. The risks of holding US debt, and by extension trusting the US dollar, are now too great. This move was not an isolated event. Japan had been sending subtle but unmistakable warnings for months. Frustration with US trade policy and the volatility of the dollar had been growing, but Japan had been patient. They had continued to quietly support the US economy, hoping for stability. But the situation reached a boiling point when the US imposed a 25% tariff on Japanese electric vehicles in November 2024, citing unfair subsidies and national security threats. Japan was blindsided by the decision, and the diplomatic fallout was swift. Tokyo responded with fierce pushback, labeling the tariffs disproportionate and unjustified. What followed was not just a trade dispute. It was a direct challenge to America's global economic leadership. Japan's response was not to escalate in traditional trade terms, but to hit America where it hurts most: the financial markets. By dumping U.S. Treasury bonds, Japan was sending a financial warning shot, a statement that they were willing to undermine America's fiscal stability if necessary. This was only the beginning. By the first quarter of 2025, Japan had become the dominant player in the solid-state battery market, controlling over 48% of global patents. Toyota, alongside Panasonic, had announced plans to launch a new electric vehicle platform by early 2026. The platform promised cutting-edge technology, offering up to 750 miles of range on a 10-minute charge, a breakthrough that left U.S. automakers like Ford and GM scrambling to keep up. As the U.S. struggled with supply bottlenecks and rising costs due to Chinese restrictions, Japan's lead in EV technology gave it bargaining power that had never existed before. The financial implications of Japan's actions went beyond trade and technology. The sell-off of U.S. treasuries wasn't just about Japan offloading its debt. It was a message to the world that America's financial dominance was under serious threat. The move sent the U.S. bond market into turmoil. In February 2025, 10-year bond yields surged to 4.89%, their highest level since 2007. Foreign demand for U.S. bonds evaporated. The Congressional Budget Office warned that this spike in yields could add $270 billion annually to the cost of servicing U.S. debt by 2027. The implications for the U.S. economy were profound. PIMCO's chief economist Tiffany Wing put it bluntly: losing stable buyers like Japan increases Treasury volatility and weakens global faith in the U.S. fiscal trajectory. This loss of confidence in U.S. debt reverberated throughout global markets, sending the dollar into a sharp decline. The U.S. dollar index fell by 2.1% in just 2 weeks as central banks around the world, from South Korea to the UAE, began trimming their dollar reserves. The broader impact was even more severe. American households and businesses now faced higher borrowing costs, while foreign investors began to question whether U.S. debt was still the ultimate safe haven. Japan's $119 billion sell-off wasn't an isolated tantrum, it's part of a much broader trend. Since 2022, the share of the U.S. dollar in global reserves has steadily declined, dropping from 59% to 54%, according to IMF data. Meanwhile, Other nations have accelerated efforts to diversify away from the dollar. Central banks in Malaysia, Brazil, and Saudi Arabia have all significantly increased their holdings of non-dollar assets, particularly gold and the Chinese yuan. China's digital yuan now accounts for 5% of cross-border transactions in Southeast Asia, while India's rupee is being used in oil contracts with Iran and Russia. Japan's decision to dump US treasuries is not just a crack in the global financial system, it's a full-on fracture. The architecture of global finance is shifting. Trust in the dollar is fading, and the demand for alternatives is growing. The world is moving away from a US-centric financial order and toward a more fragmented system, where economic power is distributed across multiple spheres of influence. The question isn't whether a new financial order is emerging, it's how fast the old one is unraveling. The ripple effects of Japan's actions were felt throughout the US stock market. Between February 3rd and February 6th, 2025, the S&P 500 lost $1.7 trillion in market capitalization, a 5.4% drop in just 3 days. The catalyst? Japan's Treasury sell-off, surging bond yields, and escalating trade tensions. But it wasn't just that. Investor sentiment turned sour as fears of an all-out trade war in Asia began to grow. When President Trump announced new tariffs on Japanese electronics and South Korean semiconductors, the fear of a global trade conflict became real. The market's response was swift and unforgiving. What had once been viewed as an economic squabble was now seen as a systemic risk, a volatile combination of protectionism, escalating trade conflicts, and fiscal mismanagement was no longer noise. It was a dangerous threat to the stability of the global economy. Investors saw the writing on the wall. The US was losing its grip on its economic future. By 2025, indicators were mounting that the foundations laid during Trump's first term had weakened America's economic resilience rather than strengthening it. The corporate tax cuts from the Tax Cuts and Jobs Act had ballooned the federal deficit to a staggering $1.9 trillion in fiscal year 2024. Economists at Brookings argued that aggressive deregulation and escalating trade conflicts had eroded America's standing in global supply chains, further exacerbating inflationary pressures. Meanwhile, America's closest ally to the north, Canada, was quietly positioning itself away from US influence. In early 2025, Canada finalized a digital currency interoperability agreement with the European Central Bank and the Reserve Bank of Australia. This move was aimed at reducing reliance on the SWIFT system and enabling direct digital settlements. Canada was also strengthening its economic ties with Europe and the Indo-Pacific region, forging long-term supply agreements with Australia and the EU for critical minerals like lithium and cobalt. This was more than just an economic shift, it was a geopolitical realignment. Canada wasn't turning against the US, but it was hedging against its growing instability. Trade volumes between Canada and the EU surged by 16% year over year, while US exports to Canada dropped by 3.4%. In a world where economic resilience increasingly meant diversifying away from the US, Canada's shift was just the beginning. Back in Europe, tensions were also rising. In January 2025, Trump imposed a 200% tariff on European wines in retaliation for EU data privacy fines against US tech giants. This sparked outrage in France, Italy, and Spain, who filed complaints at the WTO and threatened retaliatory tariffs on American pharmaceuticals, medical devices, and aircraft components. The market understood the risk. What started as a symbolic move over wine tariffs was quickly escalating into a full-blown trade war with America's largest democratic ally bloc. The global financial system was now on the edge of collapse, with the very rules that had underpinned it for decades in flux. The US stock market had lost nearly $2 trillion in a matter of weeks. Confidence in the dollar was eroding, while alternatives like the Chinese yuan and the Indian rupee were gaining ground. In the midst of all this chaos, America's place at the top of the financial world was no longer assured. In February 2025, the situation took a dramatic turn. The Trump administration openly defied a US court order to pause new tariffs on South Korean chip exports. The court had ruled that there was no national security justification for the tariffs, but Trump ignored it, invoking Section 232 of the Trade Expansion Act, despite the legal challenge. This unprecedented defiance sent shockwaves through the market. Treasury yields spiked, and foreign investors pulled billions from US equity ETFs. The message was clear. Rule of law in Washington was now in question. Legal scholars and economists alike were raising alarms. Without a stable and predictable legal system, America's economic credibility was at risk. Chief Justice John Roberts issued a rare public warning against executive overreach in economic affairs, signaling to the world that ignoring judicial checks would undermine trust in American institutions. This was a pivotal moment. America was no longer viewed as a stable, predictable force in global finance. The dollar's dominance was being questioned, and the world was looking for alternatives. The financial order that had held sway since the end of World War II was rapidly disintegrating. The question now is not whether a new financial system is emerging, but how fast the old one is unraveling. The US dollar may still dominate 54% of global reserves, but its grip is slipping fast. The IMF reported that the dollar's share has fallen from 61.8% in 2020. Meanwhile, the rise of the digital yuan and alternative payment systems like the BRICS initiative signal that the era of dollar dominance is over. America is at a crossroads. The world is no longer waiting for the US to lead. It's forging its own path forward. As global financial systems fracture, America faces the ultimate challenge: rebuild trust, regain stability, or watch its economic influence slip away. The dollar may not lose its place overnight, but the cracks in the system are widening. The global financial order is changing, and the US must decide whether it can adapt in time or face the consequences of its own decline. The world has already begun to move on. Will America follow? Like, share, and subscribe for more updates as the future of global finance hangs in the balance.